Welcome to the Life Self-Mastery Podcast, where we bring in entrepreneurs who have created online businesses and improved their lifestyles. Here's your host, Rohit Malhotra.
Hi everyone, this is Rohit from Life Self-Mastery, and today I'm excited to have Pranav Pai, who's the founding partner and chief investment officer at 314 Capital, an early-stage venture capital fund based in Bangalore. 314 manages a combined corpus of $110 million. Pranav is deeply involved with the startup ecosystem and leads investments and portfolio construction at 314 Capital. As a part of 314, he's made more than 50 seed and venture capital investments across several investment categories in India and US. Pranav is also the investment committee member of the Reliance Jio Gennext Accelerator in Mumbai. Pranav graduated with his master's in electrical engineering from Stanford University with a bachelor's in electronics and communication engineering from RV College, Bangalore. Welcome to the show, Pranav.
Thanks, Rohit. Glad to be here.
Awesome. So what got you interested to get into this crazy world of investing?
That's a good question. So I'll quickly backtrack to how I got started with tech in general. After doing my undergrad in Bangalore, I'm a Bangalorean born and raised.
Right.
I had a big decision to make. Would I continue down the standard engineering path, enter IT or whatever opportunities were available in Bangalore in early 2011? That was just the start of the startup craze, if you will. Flipkart was just getting to the $200 million valuation mark,
Right.
if you remember.
Or
the other path is, of course, go to the US or the UK or Australia. That's another standard path, and get entrenched in industry somewhere else.
Right.
I made a very interesting commitment to myself back then that while I would go to the US to study, I wanted to specialize in a set of domains that I had a lot of interest in. I had committed to myself to coming back and training myself for opportunities I would identify here while I was outside. So having an outside view in is usually sometimes the clearest way to find confidence in what you would commit to. And I found that after 7 years outside, that really gave me perspective on what I could do in a more constructive way when I came back to Bangalore. So that's how I found my edge in the intersection between tech and finance. I had the good fortune of being one of the early employees in a tech startup in the Bay Area right after graduating from Stanford. So I was on the other side of the table. I got to learn, of course, how you build a tech startup from day zero. And of course, now, as I look back, that's invaluable experience. I think the best way to learn how to invest is by first actually working in a startup or a couple of startups, seeing the path from zero to Series B, Series C, even acquisition if you can, or an exit, and understanding how the other side feels before you move on to how financing and therefore tech investing should work. So I think that's the kind of perspective I've been fortunate to have. And that's what led me eventually down to having the opportunity to start a fund like 314 when I came back to Bangalore. So that's how I got started. That's a quick 1-minute summary of my journey this decade.
All right. And what was the initial fund size when you started with 314?
So we started our first fund in 2016 with an initial commit of 50 crores. Siddharth and I, by the way, were brothers. So it was fairly easy for us to commit to working with each other because we had of course, we knew each other very well. That goes without being said.
Right.
But more importantly, we had very complementary skills. Siddharth is a CA by training, a CPA in the US. And I'm an engineer, of course, by training. He had fairly deep experience for someone his age, having run audits for large companies, having worked in one of Bangalore's top audit firms. And that gives you a very cross-sectional perspective to how businesses run, specifically in India, because of course our regulatory environment is fairly unique. We have a bunch of rules that you don't see anywhere else, at least in the top countries, at least in the US where I had most of my work experience. So both of us came together to say, look, we have a certain view of how early stage should work. And we think we can prove that with a 50 crore initial corpus. We're also very fortunate to have a extremely friendly first LP on our side. And as we look back at how that first fund performed, I'm happy to share that we were able to double the size to 100 crores fairly quickly, given the kind of companies we'd invested. And the first fund is at 100 crores and it stayed at 100 crores as we scaled out. Today, as we end 2019, enter 2020, we now manage 800 crores or $110 million as of January 1st, and we should be launching a new fund in 2020. So just to zoom out, we started our first fund with less than 10 million. And today we're at 110 million 4 years later.
In 4 years, awesome. Right. And so do you think the funds, usually the life cycle is for 5 years, and then, you park some of the money to reinvest into those startups? Is that how it works?
Yeah, that's one model we've seen. So at
Right.
314, we have a fairly deep set of principles we've committed to. The first, of course, many other things, but one among them is that we don't reinvest capital. We firmly believe that if we've invested capital, and should that capital be returned ahead of schedule, for whatever reason, maybe the company decided to fold and shut down, return capital back, or maybe it got acquired very early. So that's also sometimes a great thing, because you can, that's a good end up for the founders, especially. We always return capital back, so we don't reinvest, we don't recycle capital. And therefore our cycles are slightly longer. Usually in the early stage, we structure funds between 7 and 8 years in term. And as we go towards the mid stage, we wouldn't be surprised if it stays at 7 to 8, because now in India it still takes some more time for companies to reach maturation, and
Right.
when they're ready for a reasonable size exit. So our funds typically hover around the 7 to 8 year term.
Got it. And what is the internal, decision at 314? Who gets to decide, what are the kind of investments you want to make, and are you guys sector agnostic?
Yeah, so that's something that we spent a lot of time thinking about. When we first launched in 2016, we actually had a negative list of areas we wouldn't invest in, for very simple reasons. So I'll give you a simple example. We decided we wouldn't do anything in wallets. And if you remember back then, 2014 to 2017 was a big push for wallets until UPI came out in early 2017. And then, of course, the business model had to change. We didn't know, of course, that UPI was coming as a disruption, but turned out that not investing in a new wallet in 2015 was actually a good decision. We had a similar view of horizontal e-commerce. We fundamentally believe that horizontal e-commerce, it would be a long time before that became a sustainable business model. And that's a game for much larger funds to fight, because you need billions to stay alive and make it at scale. Turned out that's a good decision also, because most of the non-top 5 e-commerce startups, at least the horizontal ones, didn't end up surviving long term. So we had a bunch of things that we knew we wouldn't invest in for many reasons. And for each one, we had a specific set of reasons. Therefore, left a very finite set of opportunities we could chase. The top 3 among them, I'd say in hindsight, turned out to be very good decisions from a timing point of view. The first thing we decided to do was find very interesting startups in high margin areas where a lot of capital attention wasn't being received at that point in time. A good example of companies we found in that kind of thinking is, for instance, a company called Licious. You might have heard of Licious today. It's basically a category creator. It's India's largest full stack protein company. All kinds of protein products, including meat. So that was one of the examples of a high margin business that we were looking for. It's in the consumer domain, completely in the consumer domain. But because of what we would see as a very interesting side path towards sustainability, we thought that that's something that we'd like to pursue from day one, and basically help that company set up. So it's a good example of the kind of things we are looking for. The second kind of example were companies in the media and content space. Again, this was just before Jio, right? Our view was that, look, while India has very low smartphone penetration, still some of the highest cellular data rates in the world, this has to change. It's not sustainable. And we saw a future where there were more Indians online. There were far more smartphones. Cellular data was far more accessible, although Jio even surpassed our own expectations. And therefore, people will be spending a lot of time online. And if you dissect what they do when they spend time online, they communicate a lot more with their networks. So no surprise that WhatsApp became a big hit. They spend a lot of time consuming content, whether it's news, whether it's entertainment, whether it's audio, whether it's video. And of course, the third thing they do is they shop online. So we decided that number 2, where they spend time online on content, that's something that we wanted to build a very deep focus in. And we were amongst the first early stage funds to actually have a dedicated focus in media and content development that's purely digital. Fast forward to today, we're fortunate to be in some of the best media brands in the country, including Your Story, Pocket Aces, some newer ones like the podcast app in vernacular Kuku, a local news app called Local, India's largest character development studio, a company called Graphic Comics. So very interesting kind of view that gave us these kind of opportunities in media and content development. So I can go on, but this is how we basically found our niche. with our first fund. And since then, of course, we've added fintech, we've added enterprise. We have a fairly deep view of how India can develop interesting IP. They're called deep technology companies today. But the markets need not necessarily be India. You can go global with the right kind of team and the right kind of channel access. So we also focus significantly in deep tech areas, things like agri-tech, things like drone technologies, things like semiconductor design. These also form a fairly big part of our focus in India.
Interesting. You said that you had a negative list, but do you think as a fund manager, do you need to specialize or maybe generalize later on?
I think it's a very good question. It completely depends on the founding principles of the firm. So I know a lot of firms, even in India, for example, definitely in the US, that are wildly successful being sectoral firms. So only fintech or only e-commerce or only brands or only enterprise, right?
Right.
And that's a great way to find domain market fit and build a niche for yourself as a firm. The other way I've seen funds form thesis, and that's how we did it. We took the second part, is that we identify what the market is and what timing environment we are in right now. We firmly believe that given where India is right now, as in terms of its market evolution, we still think most of the digital opportunities are just starting. Right? A good example is even our enterprise markets. If you look at where are large Indian companies spending their IT budgets, they're still spending a very small fraction on new cloud-based or SaaS-based technologies. They're just starting procurement and designing their mindsets to procure SaaS technologies and use them internally, right? So you can argue that India is just about starting a India for India SaaS play, and this would be a fantastic time to add SaaS to your thinking as an early stage VC fund. So if we were only sectoral, for instance, if we were doing only fintech, if we were doing only consumer, we'd miss this entire large market opportunity opening up in front of our eyes. So we decided to be agnostic, but we decided to have a very specific set of focus areas, which we have to understand first before we get into. So that's how we've designed our firm. We think India is in a very different position. So we need to be open to opportunities here that might not be open in other countries and other markets that you would be serving.
Got it. And, you also mentioned that you looked at content and media in 2016-17, but, podcast is content marketing, but is it possible to get the kind of, valuations which what a consumer or a SaaS company would get when it comes to, content or media company? Because it's difficult to monetize such sort of platforms.
Yes, that's been the conventional thinking so far for three fundamental reasons. There were three blockers for content companies not scaling out as quickly as the other type of companies you mentioned. The first blocker was, since most digital content still runs on the ad-based monetization strategy, the CPMs in India are still fairly low compared to peers in the US or the UK or anywhere else in the top content consuming domains. Japan's a good example. So with CPIs being low, it takes far larger volumes and therefore far more time to reach the same kind of monetization you would reach anywhere else. That's been one problem. Second problem has been that there's still a behavioral change that we're in the midst of that hasn't fully fructified yet. So not one line of thinking is not enough Indians consume all of their content or a sufficiently high segment of their content purely online. But we actually think there's a large market of Indians already online that are now becoming digital first. So our view and our timing of where we are in this content consuming market is slightly, you would say slightly ahead because of the data we have from the investments we've already made. So in that sense, we think the timing, we're already in the right time. In fact, now is the time to build a portfolio because from here it accelerates far more in terms of penetration. The CPI, the cost, of course, the monetization question is still, the rates are still low. It's uniformly low for most of India. And the third big problem was that we didn't have enough local content for Indians to consume once they went online, right? So in the US, for example, I mean, just look at the world, right? Which are the top content companies that come to your mind? There's Disney. Right. If you go to gaming, there's Activision, there's Take-Two, there's EA. Again, most of them are American companies. A couple of Japanese companies like Nintendo and Sony, and then maybe you'll find something like Riot or some of the other games coming out of Scandinavia, right? Yeah. So the content ecosystem in the world is still predominantly dominated by companies that are not from India. So if you look at that as a problem, in fact, we looked at that as an opportunity. We have the opportunity to actually become the first past the gate in building a content library for India, in, of course, tens of languages, as Indians go online and start looking for more local content that they want to consume. And that's why we think platforms like Local, Kuku, Your Story, Pocket Aces, all the companies that we funded, each of them are going after specific niches of content and building very deep. We think that's like the first wave of value creation you can do when a digital entertainment ecosystem needs to be built. We unfortunately don't have the opportunity to build our own channels. So you can argue that this is true for most of the world. The UK's YouTube is YouTube, just like India's YouTube is YouTube. Yeah. The UK's Netflix is Netflix, just like India's Netflix is Netflix. But we have competition with Hotstar and Amazon Prime and so on. Very few Indian companies have actually gotten to scale to become a destination or channel of sorts for digital content. In fact, I'm happy to see that ShareChat and Daily Hunt and a few are now getting to scale sufficiently large to actually be content or channel destinations for publishing companies like the ones I mentioned, that the ones we funded. So I think while the channel opportunity needs a lot of capital, again, that's something that we couldn't do. We do have the opportunity to become the first large publishers in India, and that's the opportunity we went after.
Got it. And I run the podcast. I consume a lot of podcasts, and I also got Rennie Wang, who was the CEO of Castbox, which is one of the largest podcast directories. And,
of course, yeah.
On episode number 100, and we discussed about how monetization is a problem for a lot of podcasters. But very interestingly, you also invested into an Indian company called Kuku FM. What made you invest into this podcast platform?
Yeah, it's a good question. So while I was in the US, I also was just in the midst of that podcast wave coming up.
Yeah.
We saw three things happening in the US's podcast market. The first thing was the podcast wave actually started in 2004 or 2005, right? I remember being in school and there were a couple of podcasts on history and technology and news. NPR was one of the first ones. Those were actually fairly well produced, but unfortunately very, very small audiences. Because at that point in time, while not enough people had iPods, you didn't have as much of a easy way of connecting your iPod to your car or to a Bluetooth speaker. That kind of hardware didn't exist. You fast forward to 2015, and suddenly there are Bluetooth speakers everywhere. You have something. You don't have a smart speaker yet, but you do have a Bose or something at home. And of course, you're plugging your audio jack to your car. And if you're a commute market like the US is predominantly, where most people get to work in a car, then you want to burn that half an hour, 45 minutes listening to something. So the US is fairly different in terms of how its wave began and sustained. In India, we're seeing something else. We're seeing something which is frankly a much more exciting opportunity for us in India. Number one is we don't have one predominant language in which people are consuming audio content. While videos, you can argue English and Hindi are still doing really well, and we haven't saturated the market enough in those two languages yet. When you come to audio, people's fundamental audio behaviors are crafted by radio. And if you look at different regions in India, I'm from Karnataka, I know at least the Bangalore ecosystem fairly well. Most of our audio superstars are in Kannada or in Kannada meets English, right? And they're usually in the mornings, they're usually in the commute time. There's a fairly well-known set of RJs. This is true in Mumbai. I know this is true in Delhi. This is true in most of the country. And most of the other non-entertainment content in audio, like your news, your bhashans, your education, your edutainment, everything usually is a hybrid mix of one language and the other, either Hindi or some other local language or English and some other local language. So we thought that, look, there's a production wave that has to come that supports Indian creators in audio and brings this kind of local content online. And strangely, we still have the opportunity to build a content discovery platform or a content distribution platform alongside producing the content. So we can actually, to give you a simple analogy, build the YouTube of podcasts as well as the top videos on YouTube, right? And usually you're either one or the other, either the platform or the publisher. But in this case, as you start scaling up, your audience tells you what they want more of. And therefore you can spend capital far more efficiently in supporting the content that does best for your audience on your platform at that point in time. So that's why we thought Kuku would be a very interesting way for us to actually expand from content production, just making content, to content distribution as well, which is building a platform that on top of which the content is consumed. So that's doing fairly well so far. We're actually very surprised by how quickly that team has scaled. They're over 1 million users now. They're actually trending very, very well on DAUs. They're almost becoming a daily habit. Their top users are now using Kuku for more than an hour at once, which is fascinating. And we're learning more about how Indians consume content now. It's not just with a phone locked in front of their eyes. It's also passive listening, which is how I mentioned the US example of driving to work.
Correct.
Many people here are now with Bluetooth earphones, walking to work or going on a lunch break or trying to figure out what happened in the news with a quick catch up over a coffee. So a lot of these behaviors have also seeped into India's public life. And that's why we think the audio ecosystem is at the right time as far as building production and distribution as well. So sorry about the long answer, but this is something that we were also very excited to find. We finally have an opportunity to get in early in both aspects of the content ecosystem.
Interesting. And, do you think the ownership, when you invest into companies is based on the first check, or is it built over time? Can you get a 20% ownership in the first check itself?
Yeah, that's a good question. So that again comes down to the founding principles of the firm. I know at least a dozen very successful firms. I can argue that they basically crafted the industry, the VC industry as it is today, the firms like Sequoia and KBCV and so on, who have the very clear principle of getting to target holding, meaning whether it's 22%, whether it's 25%, each firm has its own target holding in the first round or at most by the second round, right? So even YouTube, when Sequoia committed to YouTube in the seed round, they had an internal memo whereby this memo is public, so I can talk about it, whereby by the Series A, by the next round, so within 2 rounds, they had to get to around 25, 27%, right? So we at 314 also have target holdings for each of our companies, but we average up, which means we take our holding up over time. We don't start with a large holding and then average down, meaning we let ourselves get diluted. We average up because we found that that's a much better way to manage risk. Averaging up is not a new concept. In fact, it's fairly popularly used in public markets, again, where there's high liquidity. But we find that in a low liquidity environment, especially early stage India as it stands today, averaging up is actually a great way to manage risk and not over concentrate in any one company too early in that company's journey. This is a fairly technical portfolio construction, but so far it's worked for us. So far it's helped us allocate capital the right way. And we found that founders also like getting to know us before they give us more ownership. That's true of any founder and true of any fund. I'm sure even if you went out to raise a startup tomorrow or raise funding for your startup tomorrow, you'd want to get to know the investor before you give them 25% of your company.
Correct.
So we found that works for both sides. It's a slightly different approach, but we find that that's working for us so far. Will we change tomorrow? We might. The market might change, and there might be a lot more capital available in 5 years from now. Then there's more competition. Therefore, there's more of a requirement to get your target holding as early, because then you might not have a chance later. So we will also evolve as the market evolves. But so far, we found this working for us fairly well.
Right. And Pranav, do you think with SoftBank and a lot of other late stage funds which are coming into India, do you think one of the biggest challenges is abundance of capital because of what has happened with WeWork and Uber in the last couple of years? Do you think there's been abundance of capital and the power has shifted back to the entrepreneur?
That's a good question. Actually, I don't think that's true for India yet. So just to give you some data, because this is something we study very closely, the world crossed a world record for capital invested in the venture space in 2018. I think we crossed $200 billion as per the KPMG report. That's more than any amount of money that's gone into startups in any year since venture capital started. And what happened was, if you look at where the money went, most of the money went to the late stage companies that were already thought of as winners. So the Ubers, the ByteDances, the DDs, and of course, many of the Tencent subsidiaries, the Tencent Music subsidiaries, so on and so forth, right? So what we're seeing is, while there is more capital allocated to venture than any time before, more of it is being concentrated in the top companies that are already late stage and therefore supposed to go public, but they're not. So while more money is coming, fewer companies are getting it, and that money going to them is preventing them from going public that much earlier. That's why you'll read several posts and several opinions by VCs and hedge fund managers when they argue on stage, especially in the US, that look, a lot of the value that these startups are supposed to bring to the public markets is being consumed privately before they go public. One consequence of that is when so much money rushes into this asset class, it tends to not want to take the same kind of risk, even though that asset class is overall much more riskier than, say, bonds or everything else that you've been doing with that money before you came into VC. So if that much more money wants to take less risk, it's natural that they'll concentrate in companies that are already winners, right? So that's not a surprise. As a consequence of that, there's actually less money coming into the early stage. And if you look at that same data set that KPMG published, fewer seed rounds are happening in the same time as the total capital increases. What's happening in the early stage is the same thing. There's more money, but there are fewer companies getting funded. Therefore, more money in every company in the early stage getting funded. And that's happening in India as well now, because now in India, we're going through this phenomenon of second time or third time entrepreneurs who are getting back to the game, starting their next startups, raising their next rounds. So cultivate and Jiten Gupta's company and a bunch of other companies. And actually 2019 was a big rush of second and third time entrepreneurs, and I'm sure that's going to happen in 2020 as well. We think that that's something that indicates a maturation of the early stage, where one wave of success is complete, the second wave starting, and that usually means much faster accretion of capital and much faster scale-ups towards the late stage. This is actually similar to what happened to China in the early part of the 2010s. And in 2011, 2012 is when this started happening in China. And most of the Chinese unicorns are by second or third time entrepreneurs. So I wouldn't be surprised if this accelerates, and India is actually reaching this point very interestingly at a time when we are also maturing as a venture ecosystem as a whole. So a lot of interesting convergences. You couldn't have planned for this even 5 years back, but that's what we're seeing happening in India today.
Interesting. And, you talk about SoftBank and Sequoia. Sequoia's come up with Sequoia Surge, and there are other larger funds who are playing at seed stage. So what do you think about larger funds, coming into seed stage, and how does
I think overall that's a very good thing. I think that's a really good thing. So first of all, SoftBank, look, with a $100 billion fund, it's very hard for them to do early stage. So I actually have a lot of respect for their strategy, where they're patient. They want to pick spaces and markets carefully. They want to be careful about picking the number one company and making sure it stays number one.
Right.
Of course, they put in so much capital that it takes time for the company to understand how to deploy that capital efficiently. And that's why sometimes you will have a couple of companies that don't do that very well. So WeWork's a good example. But that can't be generalized to the entire portfolio. While few companies may struggle to deploy that capital efficiently, many of them will use that capital to their advantage. Ola and so on have done so very well. And I think they will be far more success stories coming out of that late stage experiment. So I think SoftBank has shown the world that there's a lot of value to be on from having this focus on technology or venture-backed companies coming to pre-IPO. Coming back to the early stage now, since such a large fund was launched, this is again historical. You have to respect that. A lot of the typical mid-stage funds, right? They would have to go a couple of stages earlier, and then the early stage funds would have to start doing seeds. So there's been basically a left shift in terms of the stage evolution, and all the funds that are serious about capturing value from venture have had to figure out how to do that earlier. So I'm actually pleased that a lot of the larger funds from the US that have come to India, the Sequoia is a good example, the Lightspeeds, the Axels, and so on. They've actually all started dedicated seed programs. That's very good for this ecosystem, because then the rate at which good ideas get funded, so that they can test their thesis, they can test their markets, they can test their business plans, that rate accelerates, and therefore what is going to work, how to answer that question, becomes that much faster. So it becomes a much more positive feedback loop for the rest of us, who can also now understand, okay, these markets are opening up, these kind of founders are coming out to start new companies. We can help, of course, match founders to the ideas and the markets that we have some domain expertise in. So we become far more efficient at finding good people to work with, to back interesting ideas. So this whole thing has a very interesting positive spiral. And that's why I think the accelerant on the expansion of the early stage in India, these are the vectors that added to it. So it's very good. I think overall, I'm very positive about the moves that have happened over the last 3 years. And I'm very excited about what's coming over the next 5 years.
Got it. And you've been part of other consumer startups like Licious and all. Do you think we are in a consumer bubble right now? Because the CAC sizes are increasing year after year. Since the ad cost on Instagram, on Facebook is increasing. So do you think we are into some sort of a bubble there?
Yeah, that's a good question. So there are two ways of looking at that. Number one is, at this point in time, as we enter 2020, there are more Indians online than there ever have been before in history, right?
Correct.
There are more Instagram users, more WhatsApp users, more smartphone users, more internet users in general, right? So the rate at which the digital Indian citizenship is growing, it's 10 times, in fact, 25 times faster than the Indian population growth rate, which is around 1.1, 1.2%, right, per annum. So that shows you how fast India has evolved as a digital citizenry. That's number one. Now, number two, startups are not interested any longer in just acquiring any online Indian. Almost all of them that know what they're doing are going after very specific segments, right? So, for example, Byju is not going after every kid. Byju as a tech company is going after very specific segments of children in very specific cities, maybe pursuing one board versus the other, or looking or searching in Google for one term versus the other. So their segmentation now becomes far, far more finessed. Therefore, if they're paying more to sift through a much larger base to find a very specific segment, you and I shouldn't be surprised that they have to pay a little bit more to find those people, right? It's the same thing that happened in the US as well. Of course, in India, it happened much faster. It happened in 6 or 7 years here. It took 20 years in the US. So I think it's expected that CAC would increase because you're much more selective today and the base is much, much, much larger. So of course you would have to pay more to filter down. That's number one. At the same time, the kinds of segments you're going after now in India. So if you're Byju or if you're, take some other tech company, Unacademy is a good example. They've scaled really quickly. You're going now after the same kinds of populations online, and you have to therefore compete not just for attention, but also for the quality of your product, the pricing of your product, the referrals, the reviews that other kids have left on your product. So suddenly it takes a lot more time and capital to differentiate because competition's increased, right? So again, you don't mind spending more because you're trying to fight that battle for mind share in your target user segment. So again, it's a good thing that there are more companies now becoming more specialized in segmentation and now understanding who they will compete with for their attention. So I'll put all that together. CACs have to go up. Of course, because those segments are now valuable. How do you know they're valuable? They've started spending money online. You're going after the parents who you know for sure bought a Byju subscription last year. You're going after the parents who you know for sure are the profile of parents who usually send their kids for IIT coaching or whatever. So I'm just giving you one specific example. Because education is really something all of us in India have gone through, so we know about. But that's a very interesting way of understanding why the monetizing potential of these segments, the competition for the segments themselves, and the sheer number of segments over which you can specialize. Since all that has gotten deeper, costs will go up. And of course, the monetization's also gone up. More people are spending more money online. So you can actually build fairly sustainable companies if you manage to play this balance in a scientific way. Of course, you can always go wrong. You could always overspend on CAC and not know how to monetize and build lifetime value. That's a recipe usually for not a sustainable company.
Correct.
That also happens, of course. But again, in my mind, the founders who know what they're doing, I think they're using this completely to their advantage.
Right. Yeah. I mean, if they focus on building a brand, that can really help them increase the lifetime value.
Absolutely. And one thing, Rohit, that, since you also work for a startup, you'll know that what these startups are doing is very interestingly, if you just zoom out, they're trying to do in 4 or 5 years what typically used to take 20 years to do, right? Since we're on the topic of EdTech, NIIT, I respect that organization. They've trained hundreds of thousands of engineers and computer professionals and given them skills, given them degrees, placed them in a job. They've been doing this for 25 years, right?
Correct.
But what Baiju did, he compressed the entire life cycle of building a brand and building scale and did it in less than 5 years, right? And he did this for not for graduate students who are 18 to 22 years old, therefore adults who have some idea of what they're looking for. He did this for children who don't spend the money, but he had to convince parents to spend the money. So he had a two-party consumer side. So the sophistication and the rate at which you need to build these kind of brands, all of that has accelerated almost exponentially. Therefore, the amount of capital you need to spend to get through all of these things in that time frame, obviously not a surprise, has to be much higher. It's only worth it, of course, if it works. That's always true. And of course, if there's a sustainable, clear business model in the end. So Byju is a fantastic example of a company that did all this in 5 years and today is amongst the most valuable unicorns in India and surprisingly, quote unquote, profitable.
Right.
He'll actually throw profits when he reports his next year's earnings, I'm sure. So this is what India's capable of supporting today, and it's a good thing for all of us. I think it's phenomenal for India to be supporting these kind of companies, this kind of drive towards sustainability in this shorter time period, this efficiently. It's a great testament. I'm very happy to see how far we've come.
Got it. And if there's a listener who's a budding entrepreneur who's trying to raise funds, what is it they would need to do in order to apply to 314? What do you look for in an entrepreneur? Do you think it's the market size or the team or the idea? What is it that excites you?
Yeah, it's a great question. So when we were raising capital ourselves before I started 314, we would always ask this question: what does it take to raise from Fund X or Fund Y, right?
Right.
And these are big brand funds, of course, if you're in the Bay Area. And every fund has its own optimized parameter or overweight parameter. So for example, for Fund X, it might be that it's market, right? If the market's right, doesn't matter who you are, doesn't matter if you build it in 1 year or 2 years, we'll make it happen. It's the right market. It's the right place to be. I know funds that only overweight on team. Okay, I have to know you. I have to know your references. I have to have some kind of history with you. I have to be able to share the same values before I decide, look, whatever you're going after, I'm backing you no matter what, right? So and the third, of course, is a great product. It doesn't matter who built it, doesn't matter what market. If it's a product that's working, it's making money, people can't get enough of it, forget everything else, just try to rush into that company, get a piece before it becomes too expensive. So all three parameters, people, product, and market, we've seen that being used in different ways in different funds. The fourth big parameter that we try to optimize for, because these three are always important. We have to look for some combination. We try to optimize for timing. We have to be convinced that this is the right time for this team to build this product in this space, right? And that's the hardest evaluation to make, because timing is always right in hindsight. It's never right. You never have the full confidence when you're actually making that decision. So if you ask me what keeps me up at night, and therefore what we have to be really good at, if we have to attract the right kind of founders, if we have to be valuable to the right kind of founders, it's how we can pull all these four forces together to make ourselves the best possible capital partners for early stage founders. So that's what we do. And to answer your question, the kind of founders we like working with are the founders who share a similar view of all of these four parameters. They have a similar approach to what we think will work. They have a similar sense of timing. They have a similar sense of what a sustainable end product looks like 4 or 5 or 6 years down the line. And our finest moments have come when we work with founding teams that have alignment with us in all of these points. And then we work backwards. So if you want to be a 500 crore revenue company in 6.5 years from now, what are we doing in the first year? What are we doing in the first month? What are we doing in the first week? How much money are we raising now? Everything has to be worked backwards from that. So that's how we try to work with founders. We so far, I'm happy to say, done it with many of them and had a great run at it. So we look forward to doing much more of this. So founders are approaching us. This is very plainly how we think.
Right, and we'll put that we'll put the contact information in the show notes. But I want to talk about your father, Mr. Mohandas Pai, who is the ex CFO of Infosys and Padma Shri awardee. How did your father journey at Infosys change your mentality towards investing and how you look at the world? Because I think Infosys is one of the only few Indian companies which not only went on to build wealth for the founders and the employees, but also the general public. So what your time spent with your father? How did it change your mentality to look at your career and investing in general?
Absolutely. That's a great question. We debate this all the time. So it's a great question to answer. So I think the top three things that I learned from his time at Infosys, and you mentioned a lot of their success metrics, is number one, I think Infosys wouldn't be what they are today without a very clear value system being entrenched top down, right? And it comes down to Mr. Murthy, Mr. Nilekani, Mr. Gopal Krishnan, the founding team, and how they built their first layer of leadership, which includes, of course, my father, Mr. Balakrishnan, and a dozen of them. Right. So what they did was very clearly decide that there would be a certain type of company that would never compromise on a certain set of values. So whether it meant losing a client because they asked you to do certain things you weren't comfortable doing, whether it means not raising a single rupee of private capital and only raising capital when you're ready to go public. So they basically ran the entire company on their own money, on revenues, and on bank loans until they went public in the Indian markets. It's a phenomenal story. If you go online, I'm sure you'll get many accounts of that. Going from there to being the first Indian company to list on NASDAQ in 1999, and now being a $45 billion company and having created so much value for their shareholders, I think you work backwards, and aligning behind that value set is very clearly what gave them that moat. The number two thing that I think we learned from them is an uncompromising system of governance. Now, until very recently, of course, a lot of questions have been asked about, okay, what does governance mean in India? Is India an easy place to do business? Is government on your side, against you? What does taxation look like? How can rules change every year? Of course, there are a lot of questions about what you would call as the emerging Indian economy. But Infosys is amongst one of the few companies. There's HDFC and there's a bunch of them. But amongst a handful of companies that showed that in spite of whatever changes outside, right, if you're able to align with one set of standards and governance practices, nothing can shake you out of how strong a moat that builds for you. So even until today, the Infosys balance sheet, the annual report is amongst the top award earners anywhere in the world, right? That kind of principle focus, even in how they operationalize finances, that's something that unless you see it, it's very hard to know that's even possible. So that's the second big thing we learned. And of course, that feeds into how we write our reports, how we build our deck, how we give our investors, our LPs, an analysis of what we're doing. All of that is very, very deeply informed by how we saw Infosys scale out. And the third very important thing, I think this is maybe the hardest to learn. But until you do it, it's very hard to actually think it's possible, is how to think about your investors and stakeholders before you think about yourself.
Right.
Now, Infosys is one of the few companies where they've actually made, maybe the most number of lakhpatis or crorpatis as
Absolutely.
a company than most other companies you can count on. And in fact, my father was part of the team that wrote one of the first ESOP policies for a company in India.
Oh.
And there's a very, very famous story about how the taxation authorities had a lot of challenges in taxing that ESOP construct because they'd never seen it before. How do you tax something that you've never seen before, right? So that basically made employee wealth generation a very standard protocol for all of India's companies. And that's something that even today startups employ. If you've seen how you work in a startup, you know the value of an ESOP and how it can change lives.
Correct.
That's something that came down from people who thought that way. So they could all have become far richer, of course, given themselves all those shares, but they distributed that. There's a very clean ESOP policy they instituted. Till this day, it's still survived. Of course, it's gone through many upgrades. There are now 250,000 people. So how do you manage 250,000 people on a limited ESOP pool is an interesting question to answer. But all things considered, those are the kind of learnings we had the good fortune of being exposed to very early. And that I would attribute a large part of what we know and the principles we align to because of what we've learned from him. So full attribution to him and the full Infosys founding team in general.
No, absolutely. Infosys has been one of the greatest wealth creators. And I remember the early 2000s, a lot of parents wanted the kids to work in Infosys and they changed their entire ecosystem. But I quickly want to do the top three. What's your favorite business book?
Yeah, that's a good question. So I had the good fortune of being at Stanford when Peter Thiel was teaching the class that eventually became the 021 book. Oh. So that actually, I got to see the journey from lecture to underground lecture notes on on GitHub to then becoming a published book, and of course one of the all-time bestsellers in that category.
Okay.
0 to 1 has a special place in my mind. But if I zoom out to other books, this may be something that many people haven't read before, so I thought I'd mention it. It's a book by Albert Hirschman called Exit, Voice, and Loyalty. It's a particularly interesting book for me because he's an economist. He's a fairly well-known one. I like, in general, authors that take one set of frameworks or principles they've learned in one domain, and they try to apply it to another domain to see how much of a cross fabric you can build to mesh learnings and therefore give you a new way to look at things. And in Exit, Voice, and Loyalty, I think he applied economic principles to just general economics influenced social behavior and looked at how people leave organizations that they've lost loyalty for, or how they entrench themselves even further in their loyalty for some organization, or how they exercise voice, their capacity to change the organization towards the view that they hold. So it's a fairly academic book if you read through it, but it just opens up your mind to how to apply these very interesting principles and theories to everyday life. And that, of course, got me started on a number of other books. Nassim Taleb is a favorite author of mine. Skin in the Game is maybe the most accessible book he's written, so I'll mention that also. But that's a quick set of books that I really enjoyed reading.
Got it. And, if you could go back in time when you started your fund, what is the one thing you would have focused on, or anything you would have done differently? Yeah,
that's, again, I'll cheat a little bit and tell you, in hindsight, Siddharth and I will both agree we should have raised a little bit more capital because we did not have. So we started the fund with a very clear notion of setting up a track record before we raised serious capital.
Right.
But we had no idea that we would actually pick a good set of companies that actually grew so quickly. So the one thing we've learned is how to protect our stakes, our holdings in companies much, much longer. We don't like to get diluted out of our companies too early. And having more capital, of course, in your fund allows you to stay invested for long. So we fixed that problem, of course, and that's how we've increased capital under management so quickly. But that's a good lesson to learn in hindsight now and put into your first fund in practice. But we learned it the way we learned it, so no regrets.
Right. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
Oh yeah, absolutely. I pay for a lot of the great products I use. And that's a good principle of mine because now I know how hard it is to build a online-only software product. So my favorite products are Pocket. I love Pocket. It's made reading for me much easier online. Right. I organize all of my reading on Pocket. I sincerely recommend that. I think it got bought recently by Firefox. So hopefully it's going to stay alive for much longer now. It's a great tool. And I also enjoy using Grammarly. It's a writing tool. It's very similar to a bunch of the other tools that your previous podcast episodes have mentioned. Hemingway is a good example. But they've done a great job of making writing much easier.
Right. And what is the best way people can reach out to you and reach out to 314?
Oh, yeah. So we're everywhere. We're on Twitter. We're on LinkedIn. So to reach me, maybe LinkedIn's the best. It's the most focused network to find me if you want to talk about work. In general, at me on Twitter. I'm fairly easily searchable there as well. If you want to talk about everything else and work, no problem. Right. Don't Facebook me, please. I don't use Facebook as much. My apologies. Right. And to reach 314, again, we're everywhere. Our email's on our website. We have a very simple to use contact form. We're on LinkedIn, we're on Google, we're on Twitter. So at us anywhere. Right.
We'll put that in the show notes. Pranav, thank you so much for coming onto the show and speaking to us.
Thanks so much, sir. Appreciate your time. Thank you so much.
Thanks for listening to the Life Self-Mastery Podcast, where we teach you how to start and grow your online business. For more information, visit Rohit's blog at www.lifeselfmastery.com.